The dangerous part of an oil shock is not the barrel of oil. It is everything the barrel quietly touches before it reaches your wallet. Gasoline is just the first receipt. After that, the oil price starts hiding inside the truck that brings groceries to the store, the diesel that moves containers from the port, the fertilizer used on farms, the plastic in packaging, the jet fuel in airline tickets, the heating oil in winter, and the bond market's little panic attack when inflation refuses to behave. And this is where the Strait of Hormuz becomes more than a geography question. It becomes a price system problem. Wall Street would love to treat this as temporary geopolitical noise, a few scary headlines, a spike in crude, maybe some traders shouting into expensive keyboards. Then peace talks, price normalization, and everyone goes back to pretending rate cuts are just around the corner. That is the clean version. The messy version is that Hormuz is not just another sea lane, it is one of the most important energy choke points on Earth. In normal times, roughly one-fifth of global petroleum liquids consumption moves through that narrow passage. A huge share of Gulf oil and LNG depends on it. And the available bypass routes are not magic portals. They are limited pipelines, partial workarounds, and logistical duct tape. Very expensive duct tape. Here's the thing. Oil markets can survive fear. They do that every week. What they struggle with is uncertainty that refuses to clear. If a pipeline breaks, traders can model repair time. If a hurricane hits, they can estimate damage. If a war disrupts a choke point where ships start disappearing from tracking systems, insurers raise prices, producers shut in fields, tankers avoid the region, and buyers start bidding for replacement barrels. Then the market is no longer pricing oil. It is pricing visibility, and visibility is getting expensive. That is why the mainstream belief may be too comfortable. The popular story is simple. Oil spikes are temporary. Inflation is still cooling. Central banks can look through energy volatility. Consumers complain at the pump, then prices fall and everybody moves on. That story is not insane. Oil shocks do often fade. Energy prices are volatile. And the US economy is less oil intensive than it was in the 1970s. America also produces a lot more of its own energy now, which changes the impact. But less vulnerable is not the same as immune. That is the trick. A modern oil shock does not need to recreate the 1970s to hurt you. It just needs to arrive when households are already stretched, food prices are already annoying, insurance is already absurd, rent is already high, and markets have already priced in the fantasy that inflation will politely walk back to target. Because if energy prices stay elevated long enough, they do not remain in the energy category. They leak. First, crude oil rises, then gasoline and diesel rise, then shipping costs rise, then anything that travels by truck becomes more expensive, then fertilizer and petrochemical inputs move higher, then packaging costs get passed along, then airlines quietly adjust fares, then businesses face a choice, absorb the cost and watch margins shrink, or pass the cost to consumers and hope nobody notices that the smaller cereal box is now a financial innovation. Spoiler, people notice. They just do not have many good options. This is the hidden mechanism. Oil is not just a commodity. It is an input into the movement of almost everything. The global economy is basically a giant machine that turns energy into convenience. You click buy now, and behind that button is a web of ships, trucks, warehouses, plastic wrap, cold storage, factories, ports, rail lines, airplanes, and exhausted people in reflective vests. When energy gets more expensive, the machine does not stop immediately. It sends invoices, and those invoices move through the economy with a delay. That delay is why markets often underestimate the second wave. The first wave is obvious. Gas prices go up. The second wave is sneakier. Delivery fees go up. Restaurant costs go up. Produce gets more expensive. Airlines reprice routes. Smaller firms lose margins. Bigger firms use input cost pressure as a socially acceptable way to raise prices. Very classy, very spreadsheet friendly. And then the Federal Reserve gets dragged back into the room because the Fed does not control Hormuz. The Fed cannot print diesel. The Fed cannot lower interest rates and magically produce empty tankers willing to sail into a conflict zone. But the Fed does control demand. So if energy-driven inflation keeps spreading, the Fed has fewer reasons to cut rates and more reasons to stay tight. That is how an oil shock becomes a bond market problem. If inflation expectations rise, Treasury yields can rise. If yields rise, mortgage rates stay higher. If mortgage rates stay higher, housing remains frozen. If corporate borrowing costs stay higher, weaker companies feel pressure. If consumers are paying more for gas and groceries, spending slows. So the oil shock starts at the pump and ends in your mortgage quote. Very normal, very healthy, nothing to see here. Now, the numbers are what ruin the mood. Brent and WT. I have been swinging hard because traders are not just pricing supply, they are pricing headlines, ceasefire rumors, shipping opacity, emergency reserves, and whether flows through Hormuz are real, restricted, or just invisible. U.S. gasoline is still sitting around the low $4 range nationally, while diesel is above $5 per gallon. That matters because diesel is the blood pressure of the physical economy. Your groceries do not teleport to the supermarket. Your Amazon package does not arrive by vibes. A lot of the economy still moves on diesel. And U.S. inventories are not exactly screaming abundance. Commercial crude stocks recently fell by about 8 million barrels in a single week. The Strategic Petroleum Reserve has been drawn down heavily, with stocks around the mid 300 million barrel range. Refineries have been running at high utilization, which sounds good until you remember that high utilization also means there is less slack if something breaks. Meanwhile, the inflation data is already showing why this matters. Energy prices were up almost 18% year over year in the latest CPI data available. Gasoline was up more than 28%, and airline fares were up more than 20%. Food at home and food away from home were still rising too. This is not a prediction that everything explodes tomorrow. It is a warning that the inflation story is more fragile than the market wants to admit, because the market is addicted to the rate cut story. Rate cuts are the financial world's comfort blanket. Stocks like them, real estate likes them, private equity likes them. Crypto definitely likes them because nothing says revolutionary technology like begging for easier monetary policy. But oil shocks complicate that story. If inflation is cooling, the Fed can talk about cuts. If energy keeps pushing through shipping, food, packaging, and logistics, the Fed has to ask an uglier question. What if cutting too early makes inflation expectations worse? That is the part markets hate. Not because it is complicated, because it threatens the trade. Now let's make this human. Imagine a middle-class family. Let's call them Sarah and Mike. They are not day traders. They are not macro tourists. They do not wake up checking Brent futures while pretending espresso is a personality. They just have two jobs, one car loan, a rent increase, a grocery bill that keeps acting like it joined a gym, and a child who somehow needs new shoes every 6 weeks. At first, the oil shock looks like gas. They pay an extra $15 or $20 at the pump, annoying but survivable. Then groceries creep higher because freight and packaging costs moved up. Then the airline ticket for visiting family is suddenly ridiculous. Then their favorite local restaurant raises prices because ingredients and delivery costs went up. Then the small business Mike works for delays a hiring plan because margins are getting squeezed. Then Sarah checks mortgage rates and realizes the rate cuts are coming story may have been less of a forecast and more of a bedtime story for asset prices. That is how macro becomes personal. Nobody sends Sarah a letter saying, "Congratulations, you are now experiencing energy pass-through." The economy just charges her more. This is why Hormuz matters. Not because every viewer owns oil futures, because everyone lives inside the price chain. The historical parallel everyone reaches for is the 1970s. And yes, we need to be careful here. This is not the 1970s. The US economy is more energy efficient now. Domestic production is much larger. Central banks understand inflation psychology better. We are not replaying the same movie with better haircuts, But history does rhyme in one uncomfortable way. In 1973 and 1974, the oil embargo helped turn energy into a macroeconomic weapon. Oil prices nearly quadrupled, and the shock fed into inflation, growth fears, and policy mistakes. The lesson is not today equals 1973. The lesson is that energy shocks become dangerous when they stop being isolated price moves and start changing expectations. That is the real risk now. A short oil spike is a headline. A persistent oil shock is a tax. A persistent oil shock during a rate cut fantasy is a market problem. The modern parallel is 2022. Back then, energy prices helped keep inflation politically painful and economically sticky. Gasoline was not the whole inflation story, but it was the part everyone saw every week. It shaped consumer psychology. It pressured central banks. It made transitory look less like a sophisticated macro term and more like a group project nobody wanted to admit had failed. Today's setup is different, but the warning is familiar. When energy becomes unstable, people do not experience inflation as an index. They experience it as a series of annoying little betrayals. The gas bill, the grocery receipt, the shipping surcharge, the airline fare, the restaurant menu, the rent renewal that stays high because rates did not fall. And once households believe prices only go one direction, inflation becomes harder to calm down. That is why the Fed cares, not because central bankers enjoy ruining everyone's mood, although sometimes you do wonder. They care because expectations matter. If businesses believe customers will tolerate higher prices because energy costs are up, they may pass through more. If workers see real wages squeezed, they demand more. If investors believe inflation will stay above target, yields move. If yields move, the whole asset pricing machine has to recalculate. That is the feedback loop. Oil shock, higher input costs, business margin pressure, consumer price pass-through, sticky inflation, less room for rate cuts, higher yields, more pressure on households and businesses. Then weaker demand becomes the thing that eventually balances the market, which is economist language for prices get so painful that people stop buying things. Beautiful system, very elegant, 5 stars. So what does this mean for viewers? First, do not judge the oil shock only by crude prices. Crude can fall for a week while diesel, insurance, freight, and refined product markets remain tight. Second, watch diesel, not just gasoline. Gasoline is what voters feel. Diesel is what supply chains feel. Third, separate prices are down from the panic high, from the problem is solved. Markets love declaring victory after a relief rally. Real supply chains are slower and much less interested in vibes. Fourth, follow who benefits and who pays. Producers with available supply benefit. Refiners with pricing power benefit. Traders with volatility benefit. Households, small businesses, importers, airlines, and lower margin companies pay. Fifth, be careful with the rate cut narrative. If inflation risk returns through energy, the Fed may not get to deliver the easy money story markets want. And sixth, remember that uncertainty itself has a price. A fully closed choke point is obviously bad. But an opaque choke point, where some ships move, some disappear from tracking, insurance costs rise, tankers hesitate to return, and producers cannot confidently restart output, creates a different kind of problem. It makes the market harder to trust. And when markets cannot trust supply, they overpay for safety. The uncomfortable truth is, oil shocks do not need to destroy the economy to damage ordinary people. They only need to last long enough for the system to reprice everything around them. That is why the temporary volatility story is dangerous. It might be true. Maybe diplomacy improves. Maybe flows normalize. Maybe inventories stabilize. Maybe crude falls. Maybe inflation keeps cooling. That outcome is possible, but the mechanism is already visible. Energy is moving through the price system. Businesses are talking about pass-through. Consumers are using more credit. Supply chains are under pressure. The Fed's rate cut path is less comfortable than it looked. So the real question is not whether oil goes up tomorrow morning. The real question is whether markets are underestimating how many prices oil touches before the shock is over. Because gas prices are the opening scene, the main plot is inflation. So, which one do you think this is? A. Temporary oil panic. B. A second inflation wave. C. A broken system working exactly as designed. Pick one and watch the pump, the grocery receipt, and the bond market. They may be telling the same story. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.